Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We get a lot of requests for him when we're covering oil and natural gas, the energy markets. He's one of the top experts. He's been writing an oil and natural gas energy investment newsletter for over 2 decades now at different companies. He works with my former boss, Roger Conrad, over at the Energy and Income Advisor. They have a number of other paid newsletters with master limited partnerships, dividend growth, and the large cap oil and natural gas companies, which there's just absolutely enormous rumors now, tons and tons of smoke. Reporters covering this all the time now of takeover rumors of BP. So I thought it would be smart to bring back on Elliott Gue. Thank you for joining me again.
Thanks for having me.
So, Elliott, we're recording this interview on Friday, June 6th, 2025. West Texas Intermediate crude. It's rallied a little bit, but it's been kind of at the bottom of a trading range. It's rallied a little bit in the last week or so. It's almost up to $65 a barrel. Brent crude is just under $67 a barrel. I want to get your thoughts, though, on the policies out of Saudi and OPEC, because in the past, when the oil price was, high 50s or low 60s, don't you think that the Saudis and OPEC would have been more aggressive with production cuts to try to get the price up?
Well, yes, generally, historically, this OPEC and Saudi Arabia in particular have stepped in to support the oil market when prices are down in this range. The one thing I would say, though, is that, oil has, I think, held up surprisingly well considering the news flow that's been out there. If you think about it, back in March and early April, there was a lot of talk out there about, a potential global recession, right? And then in the middle of all of that, right, on April the 3rd, I believe it was, OPEC comes out and, they announced late last year they were talking about this 2.2 million barrel a day voluntary cut that they had in oil production across all of OPEC, right? And OPEC plus, including Russia. And they were talking about gradually gradually increasing production to take away that 2.2 million barrel a day cut. And so they were talking about doing it at the rate of, I think, about 135 or 140,000 barrel a day increase starting from April. But they come out on April the 1st and say, we're not going to do 137 or 138,000 barrels a day of production increase a month. We're actually going to do 411,000 barrels a day, right? So it's 3 months of production increases per month. They announced that on April the 3rd. They announced it again in early May that they were going to do another 411,000. And they just announced it here, last week or earlier this week, actually, in June, that they were going to do another 411,000 this month. So, already by next month, by July, they're going to have taken back, more than half of that 2.2 million barrel a day production cut they had in place. And, despite all of that potentially disastrous news for the oil market, oil fell to $56 or so, $57 a barrel. I'm talking about, West Texas Intermediate here in early April, and now, as you said, we're right back up to $65 a barrel. There was a lot of talk. I saw reports out from various banks talking about, $45 oil, $40 oil, sub $50 oil. And, that just didn't happen. And I think what it reflects is the fact that the oil market is nowhere near as loose as I think a lot of people think it is. What's been a problem for oil is this view that's out there. IEA and other groups have sort of been harping on this idea that there was this huge glut of oil on the global market, and even if OPEC remained restrained on production, we would still see supply greater than demand. Yet here we are. OPEC is actually returning production at a much faster pace than most people had expected. They've announced three mega increases in production on 3 consecutive months. And, global oil inventories are pretty low, actually, right? Oil
Hasn't there been a
prices.
surprise drawdown? Sorry to interrupt you. Hasn't there been a surprise drawdown in global oil inventories to add to your point there over the last year or two? I think the inventories
Yes.
are down a lot compared to what the projections were. So these
Yeah.
projections from these agencies that you said, IEA, EIA, they've been
Mhm.
off a lot because the inventory drawdown has been larger than expected.
That's right. And you've seen consistently, right? Almost every year they come out and say, okay, well, there's going to be a big surplus of oil in Q2, Q3, and then there isn't, and they kind of push it out. They push out this glut further and further into the future. And the truth is, we're just not seeing it. And there are a few reasons for this. I think one of the big ones is that a lot of these forecasts that you see from International Energy Agency and others have been forecasting this massive surge in U.S. oil production, and that's just not happening. U.S. oil production today is about the same that it was 2 years ago in 2023. In fact, it's not up very much at all from the 2020 peak level, which was, February, I believe, of 2020, right before the COVID lockdowns, right? And the thing
Well,
is that, there are a lot of moving parts in there, but if you look at the raw data, it's about the same. And if you look at the so-called production adjustments, which is basically an error term that the EIA puts in, and what it means is that their supply and demand numbers don't balance with the inventory data. And the inventory data is considered more reliable because companies report exactly how much oil they put into storage or pull out of storage each month. And what we've seen is that the numbers don't add up, and so EIA has this error factor, this fudge term, if you will, to make their numbers balance. And consistently, we've seen this negative adjustment factor over the last couple of years, which means that they are over-reporting, U.S. oil production by a considerable amount. So, and then, I listen to, in addition to looking at these, data sources like EIA and IEA, I also like to listen to the actual companies, right? And, just got finished listening to, dozens of these companies in their Q1 call over the last couple of months. And I can tell you, you're not hearing a lot of talk about increasing production. You're hearing
it's the
about companies.
opposite.
It's exactly the opposite. You're hearing a lot of companies talk about cutting capital spending, potentially cutting capital spending even more if oil prices don't recover significantly. And they're not investing in new oil and gas production with prices where they are today. So, and the longer prices remain low, the faster U.S. oil production is going to decline. I think if oil production or if oil prices remain, sort of in this low to mid 60s range, it's not hard to imagine a scenario where by early next year, a lot of these companies, the U.S. oil production is down, 500,000 barrels a day. And I think there's a misunderstanding out there. A lot of people say, okay, but, a lot of these oil producers say that their break-even price for oil production is, $40 a barrel, $45 a barrel. And that may well be true. But the problem is that, obviously, if you're a producer of oil, you're not going to maintain your capital spending until you start losing money and then cut it, right? You're going to set your capital spending based on how much money you can make at current oil prices or where you expect oil prices to be in the next few quarters. And if oil prices are too low for you to generate, a reasonable return on your investment, you're probably going to cut capital spending, allow production to fall, and then seek to produce those barrels, when prices are more attractive. We're dealing with a very different industry today than we were 5 or 10 years ago. 5 or 10 years ago, you had a lot of little companies out there, shale producers, who were focused on growth and growth in barrels of oil out of the ground every single day, right? And that was how they supported the valuation of their stock, by showing growth.
Yeah, there was a
Now,
lot of companies that were doing roll-ups, right? So they would go buy
yeah,
private wells or private equity deals, and then they go publicly traded. So that was like Cimarex or Parsley Energy. And over the last 5 to 7 years, those companies have all been bought. The assets have all been acquired and rolled up into larger publicly traded companies.
and even there are only a few private producers left because most of them have gotten bought out. And usually, what happens is these bigger, public producers will buy the private producers and immediately slash capital spending. They're not interested in growing production. What they're interested in is creating an inventory of wells that they can drill over time. And they set their drilling plans and their capital spending plans based on how much free cash flow, can they generate at the current level of oil and gas prices, right? And mainly what investors want to hear, if you listen on these calls, what people want to hear is, how much free cash flow can you generate at the current, you know, price of oil or the strip price of oil over the next couple of years? And, what are you going to do with that extra capital? And the answer they want to hear is, of course, buying back stock, paying back debt if they have any, right? Which a lot of these companies have little or no debt right now. And or, so dividends, buybacks, and debt paydowns. And that's it. So the idea that that you're going to see U.S. oil production grow 1 million barrels a day, 2 million barrels a day, or some of these crazy numbers I've seen out to 2030, it's just insane.
Well, how do you grow oil production like that when, if you look at a 3-year chart of the U.S. rig count, Elliott, the rig count, I think, peaked in January 2023, so like 2.5 years ago, at around 627 rigs, and I think it's down to around 461 rigs when I looked at it a couple days ago. That's like a 27% drop. I mean, how
Yeah.
do you grow production when the rig count is falling that much?
Yeah, I mean, it's very difficult to. Some of them, right, can make up for some of that through better efficiency. Producers they've learned a lot over the years. You learn by doing in this industry, right? So they can produce more oil with fewer rigs, and their capital efficiency is improved as well. If you look at it, what you see from a lot of producers is they'll maintain or increase their production guidance, but they'll cut their capital spending guidance. And that's because, they're drilling more efficiently. But you can't make up for all of that with greater efficiency. They're going to see, I think, production more likely to plateau and then begin to fall in future than you're to see a large increase in production.
Okay, so
The
you're
other
saying
issue,
these acquisitions that have been done in the last 12 months that closed recently, whether it was Exxon Mobil buying
mhm,
Pioneer
yeah,
or ConocoPhillips buying Marathon. I think EOG just did a pretty shrewd acquisition in the last
yeah.
couple weeks, where they got a deeply discounted oil assets, 50% oil, 50% natural gas production. You're saying that these are being done to replace inventories rather than solely focus on growth.
Yeah, they're opportunistic, right? Where they're taking advantage of low valuations in the market right now, as you mentioned, DOG. But the other major thing is just maintaining an inventory of acreage you can drill through, prime drilling locations. So you take a company like Exxon, right? They already had some acreage in the Midland Basin, and Pioneer's assets were in the Midland Basin, which is sort of the eastern part of the Permian, if you will, the part that's all in Texas. And so by buying Pioneer, Exxon added a bunch of acreage very close to their existing acreage. So this is acreage they know very well. They know exactly how to design the wells on that acreage. They know exactly probably how many drilling locations they have on the best acreage. And also by having contiguous acreage, it's right next to each other, it makes it easier to drill, long lateral wells, long horizontal wells. So it really is all about assembling acreage, known acreage around these core plays in the fairways of these plays that you can produce over time, and increasing the amount of inventory you have, both in terms of number of locations, but also in terms of how long you can maintain production. Um, I think it's important to remember that for decades leading up to the shale boom years, how did these big energy companies work, right? How did Exxon make their money? Well, usually they would say, okay, let's assume a low price of oil, whatever it might be at that time. $30 a barrel back in the day was a common one. And they'd say, okay, if we develop this field, how long can we maintain a peak level of production from this field? At $30 a barrel, will we make enough money to return our initial investment in producing and developing the field, as well as a reasonable return on investment? And they realize that sometimes oil prices are going to be much higher than their assumed commodity price level, and sometimes they're going to be lower. But over a normal cycle where oil prices averaged around X dollars, could they make a return on their investment? And that's how they did it. And all these international projects were developed in that way. And that's exactly what they're doing in shale. Exxon is saying, okay, well, how many acres do we need to sustain, a plateau level of oil production from the Permian of, X million barrels a day, right? And they're finding that by buying Pioneer, they've got enough inventory to build up production and then sustain it for a long-term period for 15 years maybe or longer. And assuming a low level of oil prices, even $40 or $50 a barrel, they can generate some return on their investment with this acreage. So it really is it's simple economics. Why they make these types of deals. It's not that they're I think there's a misperception out there that these companies are buying to grow. They're not really buying to grow.
It sounds similar to mining, Elliott, where a mining company like a gold or copper miner has a producing mine, and then they go and buy the land around the producing mine. It's called like brownfield. So there's some
Yeah,
exploration drilling, and they know there's a resource there, and they're like, well, we already have the infrastructure set up. We don't have to build a whole new mine, a whole new mill. We could just
right.
take the deposit next door that's not that far away, and either build a conveyor belt or move these earth mover trucks there. It sounds similar to the mining industry like that.
Right, right, and it's and what you're seeing is you're seeing these acquisitions being made, but then they're literally reducing production from the existing acreage or reducing capital spending on the existing acreage because they're not interested in growing production. They're interested solely in having an inventory of drilling locations so they can gradually ramp up production to a plateau level and maintain it.
Okay,
It's
so you
exactly
said
the
they're
same.
more focused on profit margins and free cash flow and growth for growth's sake. I mean, that's what the shale industry did. We've talked about this in past interviews, the boom
Yeah.
and bust cycle, right? Where they were run like unprofitable Silicon Valley tech companies that were raising money from pension funds and private equity and anyone from what 2009 to about 2015 or so before the bear market got in there and the natural gas prices crashed and the oil prices crashed. So like those days are over basically is what you're saying. They can't do that anymore.
They can't do that. They don't want to do that anymore. However you want to look at it. I mean, those days started to change in 2018 by my reckoning for most of these companies. Pioneer, which we were just talking about, which was required by Exxon, they were one of the first to do that, where they refocused their entire business model on free cash flow. So the question they asked themselves when setting making capital spending decisions wasn't how much are we going to produce with X billion dollars in capital, but it's how much free cash flow can we make if oil prices are say $60 or $70 a barrel, um, depending upon different levels of free cash or different levels of capex that we invest in the business. So yeah, it's been like that for a while. The Like many industries in the early years of an industry's development and growth, there's a lot of focus on growth. There's a lot of focus on volume because investors are very much interested in, who has the best acreage, who's growing their production the fastest. But as time goes on and the industry matured, it became, much, much more of a traditional, free cash flow and uh, energy type of business, a traditional commodity business, where it's all about, it's highly cyclical, but it's all about, how much free cash flow, how profitable can we be through the cycle. And you're now seeing it, right, where these big energy companies, Exxon, Chevron, all of them, right, the large independents like
Like
Fang
ConocoPhillips or
or
EOG.
well, EOG, Fang, which is also in the Permian. They're all buying up. They're basically becoming industry consolidators, and there are a few big, highly responsible companies that are controlling most of the production out of a play like the Permian.
I was actually going to ask you about the comments that the CEO of Diamondback Energy has made recently about
Thank you.
basically
Yeah, that's Fang. I was calling it by its ticker symbol. I apologize.
well, that leads me into my question because there's been some really interesting comments by both Harold Hamm of Continental Resources. He said basically Permian Basin U.S. oil production needs at least $75 a barrel for free cash flow and for maintenance capital expenditure, growth capital expenditure. He said basically $75 a barrel West Texas Intermediate. And then we had the CEO of Diamondback Energy over the last month or two. He said that basically like the Permian Basin, it's going to be really, really tough to grow oil production anymore going forward. That like a lot of the tier one acreage is gone 1, additional growth will require a lot more capital expenditure. And then once we get into tier 2 acreage, we're looking at substantially higher costs. Do you agree with those statements? Or do you think that one of them's kind of wrong?
No, I think that's very true. I think that one of the big problems a lot of the Permian Basin producers have is the gas to oil ratio, the ratio of natural gas production to oil production. And what we're seeing is that gas to oil ratio is rising. And what that means is that over time, as wells age in the Permian, initially they were drilled to produce primarily oil and some gas, right? But over time, the production of gas rises relative to the production of oil. So even as the production overall declines, each barrel of oil equivalent has a higher gas weight to it, and the oil weight goes down. So as your gas to oil ratio changes over time, as the production of gas from older wells rises relative to the production of oil in terms of your total production mix, it becomes harder to grow oil production. So you can grow overall BOE, barrels of oil equivalent, but a lot more of that BOE is going to be gas or natural gas liquids like ethane, propane, butane, etc. And less of it's going to be oil. So you have to drill even more aggressively to increase the oil side of that equation. And I think this is something you're going to see talked about more and more as time goes on, is that when these companies increase their capital spending, their overall production is going to grow. Their oil production is going to grow too, right? Say, oil prices got to $90 a barrel or something, you start to see an increase in the rig count. But that gas production is going to grow faster than the oil production. The natural gas liquids production is going to grow faster than oil production. And it's going to be very hard to move the needle on actual oil.
Well, as we said
this is
before we
something
started
that's,
recording, sorry to interrupt you. As you said before we start recording, I just don't see a huge demand growth, like clear picture, like what's going to grow demand by more than say 1 million barrels per day per year. So from 93 million barrels per day, I don't know if that's the current number for oil demand per day. It used to be that I think a few years ago, up to 94 million barrels. So that's like not a huge increase. I see a much clearer growth demand projection growth for natural gas, whether that's liquefied natural gas exports to Europe, Asia, Latin America, and then also for the data centers for artificial intelligence.
yeah, on the demand side of the equation, I would say that the outlook for natural gas is probably a little easier to get your head around or get your hands around at this time. I would say though that I do think that oil consumption will grow globally, and mostly it's going to be driven by, excuse me, your emerging markets. You look at a country like India, right, for example, and in terms of oil consumption per capita, they're kind of like where China was 20 years ago. Okay. And over time, as India grows, the economy grows and develops. And remember, India has been growing at a faster pace than China over the last 5 to 7 years. Car ownership goes up and oil demand increases. That's why I think we were talking about this a little bit before we turned the recording on. But back in after the Russia-Ukraine war broke out, and you had countries like in Europe saying they're not going to import Russian oil anymore. You also saw Russian oil production didn't decrease. Russian oil exports didn't decrease. They actually went up, which is normal, by the way, when you have a country that produces commodities and they're involved in a war, their production almost always increases because they need the cash, right? And that's exactly what happened with Russia. Their oil production went up after the Russia-Ukraine war started. It's just that their end markets changed. So you had oil-hungry emerging markets like India increase significantly their imports of Russian crude because they could get it at a discounted price, and they need more oil to meet their growing, domestic demand. So I think that the demand growth outlook for oil may not be quite as obvious or it may not be quite as immediate as gas right now. I've favored for all of this year and starting in late last year, really favored the natural gas side of the equation over oil from an investment perspective. We've really been pounding the table on the gas producers and everything in our newsletter. But I do think that the oil demand side is a little bit underappreciated. We are seeing growth in demand for oil as it has for many, many years. It's been coming from your emerging markets, not the United States or Western Europe, which are mature economies where oil demand has been flat to down for years. But the emerging markets, the Indias of the world, are seeing strong growth, and I think that there is an overfocus on the idea that electric vehicles or EVs are going to take over from traditional internal combustion engines.
I also think there's been an overfocus by investors at like institutional investors, hedge funds, private equity. A lot of the professional investors, newsletter writers, they've been focusing on the natural gas side more and nuclear power. So I think like nuclear power is underinvested and has a bull market, but I think like the oil assets, they've been unfairly deeply discounted. Right. So that's why you're starting to see all these rumors now, BP. I mean, like many, many years ago, you've been doing this longer than I have, covering just oil. Would you have ever expected many years ago that someone would try to go through all the hassle of trying to buy BP, but the assets are that discounted now, and now there's activist investors that have bought into shares of BP large amounts that they're on the board of directors. They're going to either try to force BP to sell assets or to put the company up for sale.
Yeah, and it's the problem with on the oil side of the equation is because this idea has been around for a while now, that, oh, well, US or global oil demand growth isn't that strong, electric vehicles are on the rise, all this, right? This view out there. So even as oil demand continues to grow, right, and bounces back far faster than anyone expected from the 2020 mess, right, you still have a lot of people saying, well, we don't need more oil. So there hasn't been as much capital investment in new projects as you've seen in prior cycles. And another view that was out there, which is kind of a corollary to that, was, okay, well, any growth in oil demand can totally be satisfied by growth in shale production, which, as we talked about, is not what some people expected.
Well, it was true for 15. It was true in the past. It was true for 15 years. So the Permian Basin, the average person doesn't know this. The Permian Basin was responsible from 2008 to about for 15 years, give or take, for roughly 85% of all the global oil production growth. So the Permian Basin was all of the global oil production for about 15 years. But those days are probably, this field, according to the Diamondback Energy CEO, Harold Hamm, others, we're going to need a higher price floor. Tier 1 acreage is almost gone. The production growth is going to be very expensive and very difficult going forward. So the days of the Permian Basin growing at those levels that you talked about in the past, those days look like they're in the rearview mirror.
That's right. And without the U.S. satisfying most of global oil demand growth, it has to come from somewhere else. And don't forget that old conventional oil fields, particularly, naturally see declining production over time. So every year, oil production goes down somewhere in that 3 to 5% range, right? Unless you start enough new projects to offset that base decline. And the problem that we're kind of dancing around here is the idea that because the idea has been that the world doesn't need more oil production except for shale, we haven't seen that much investment. So, a lot of these companies, countries that are big oil producers, they have not invested in expanding new projects in new capacity. So we're behind. And, we've seen it with the big producers, and this fits right in with what we're talking about with BP. Historically, and I'm talking back to, if you go back to the 70s and whatnot, when oil prices were low, your big oil producers invested more money. They poured more capital spending into exploration and development because they knew that once the cycle turns, they were going to want to have that new production to come on stream, and they could make these investments at low prices, right? When oil prices were relatively low because, labor was cheaper. Getting concessions from foreign governments is easier when the price of oil is low, whereas they get a little bit demanding when the price of oil is really high, right? And, it takes years to bring a new project on stream. But this last cycle, BP, Shell. Okay, back in 2017, people forget that the CEO of Shell was this guy Ben Van Beurden, and in 2017 he said, "I'm going to start driving an electric vehicle." Right, and he said that that the price of oil was going to be lower for longer. Right, this is right at the bottom of the cycle, and so they
Whoops.
didn't they didn't invest in BP in 2020. They were saying in 2019, their oil production was right around 2.6 million barrels a day, excluding the Russian assets that they had at the time. And they were saying that by 2030, they wanted to cut their oil production all the way down to 1.5 million barrels a day. They were going to let it drop to 1.5 million barrels a day because they were going to increase their production. They were going to increase their investment in renewable energy plays and renewable energy projects of all sorts, everything from biofuels to wind to solar projects. And they were going to allow their conventional oil and gas production to decline. And so this was the mindset back in 2019, 2020, right at the bottom of the cycle, right? And so there wasn't any new investment. The only companies that did anything were Exxon and Chevron, the two American producers, which, consequently have a far superior, valuation to any of the European majors. And it's a little sad, really, because if you go back to, the early days of the oil industry back in the middle of the century, say, last century, BP, Shell, all these companies were very innovative, very aggressive. They were major producers. They were spending a lot of money developing new fields, new techniques. They were every bit as innovative, really, as the Americans. But this last cycle, they pulled back right when they should have been pushing the accelerator. And they're paying the price for it now. But we're also paying the price for it globally because there's only a handful of big non-shale projects out there. I would say Guyana is the biggest, which is, of course, majority controlled by Exxon. They're the operator there, and they had trouble. The reason that Hess ended up with a stake in their Guyana assets was because nobody else, right, wanted to invest in Guyana when they announced, even after they announced their first discovery there in, I think it was 2015. And I believe it was Shell was originally an investor in it, and they pulled out, back in the late 2000s, I believe they pulled out fully. And so Exxon was trying to find another partner for the project, and they ended up with Hess, which is a smaller producer. So all these big energy companies, Shell, BP, Total Energies, all these big energy companies basically hit pass on what's arguably the best energy, the biggest energy find in the world in the last 20 years. Because they were so focused on this idea that they wanted to invest more in alternative energy and that, the oil market was dying, that they didn't follow the normal playbook, the well-worn playbook for down cycles of, investing when at the down part of the cycle in anticipation that as the cycle recovers, you're going to want to have new production coming on stream. So yeah, it's a real problem, and it's a challenge for the world as a whole because outside of shale, there just hasn't been enough investment in new supply.
Oh yeah, I agree. And excuse me. And OPEC has other commitments for social programs. Saudi
Yeah.
Aramco is paying out a dividend. Some of their shares are publicly traded, so they have other capital commitments besides just running their oil business. They have to. A lot of these OPEC countries, which own the majority of the world's oil reserves, they have to use the oil profits to fund the government and the social programs and all that stuff domestically. And that's not even counting the energy demand usage growth. So gasoline, diesel, that stuff, where there's huge explosions of demand for the domestic production inside their own borders. So that's like Mexico. Pemex is not a huge exporter of oil anymore because of how much oil demand growth has been inside Mexico. You have this with many current or former OPEC countries. I think they kicked Indonesia out of OPEC a number of years ago because they had so much oil demand growth inside their own borders that they couldn't really export that much oil anymore.
And I think that's one of the reasons why you've seen OPEC do what they did, where they've accelerated these production increases. The main reason is that the only country which did anything really to support price of oil was Saudi Arabia. Now they cut their production very deeply, but most of the other countries were producing well above their quotas. So, if you remember back in 2020, 2021, 2022, you had these OPEC countries all had these quotas that they were supposed to meet, and they would advertise these big production cuts, millions of barrels a day in voluntary cuts from all these OPEC countries to support the oil market. But the truth is that most of these cuts were phantom cuts. And they did this in a couple different ways. One way is they said, okay, in order to advertise a cut, you have to have a baseline. So you have to say, okay, well, we can produce 10 million barrels a day, but we're only going to produce 8, right? So they made up these baselines based on historic production figures for a lot of these countries, like Nigeria, for example, that they haven't produced that much oil in years, and they couldn't if they wanted to. And so the reality is that most of this, 411,000 barrel a day production gain that they're advertising right now, it's not real. Kazakhstan has been producing well over their quota for several quarters now. So they're producing maximum what they can produce anyway. And I'm sure Saudi Arabia is a little frustrated because the only country in OPEC which ever adheres to their production quotas is Saudi Arabia, or sometimes some of their closely aligned neighbors in the Gulf, like the UAE, United Arab Emirates, or some of the other Gulf countries will adjust their production a little bit. But Saudi Arabia basically carries the whole load. And my guess is they're sick of it. My guess is that they also are looking at the global oil market and saying that, these people are crazy. They're saying that there's this huge glut of oil, but all we see is inventories come down, right? I also think another sign that's out there, a couple other things out there that I've noticed about oil is the commercial commitments data, which is hedgers in the financial futures market, particularly WTI. These are the largest hedgers are producers, right? So oil companies that produce oil, they sell oil futures to lock in the price. Well, they're not selling oil. With prices low all year, they have been hedging less. So what that tells me, typically when that happens, that means that the producers don't believe that the current level of oil prices is sustainable. And, producers know a heck of a lot more about supply and demand conditions than you or me or even the IEA, right? Because they're seeing it firsthand, involved in the industry. They have access to material, non-public information. If they're not hedging, that tells you, that the supply-demand picture is not as negative as some would have us believe. The other thing I've noticed lately is, look at the refiners out there. Look at a company like Valero, right? Marathon, TDF even, which is a small one with operations in California. All these refiners have been on the roll lately. And, generally speaking, refining companies are the only major sector of the energy business that does not benefit from higher oil prices, right? Because, Valero, their business is to take oil and make gasoline, heating oil, diesel, jet fuel, kerosene, you name it, right? So if the price of oil goes up, their costs go up. They make money based on the spread between the price of oil, which is cost for them, and the value of gasoline, diesel, heating oil, etc., all these refined products. And refining margins, when they expand, as they have been recently, it typically happens because demand for oil is actually pretty robust, global demand for oil. And so I think what you're seeing is evidence that, global oil demand is actually a lot stronger than people think. And it suggests to me that quite possibly that Chinese oil demand is bouncing back. It was very weak last year because the economy was weak. You probably have strong oil demand growth continuing from places like India. And, I think, U.S. oil demand is likely holding up a lot better than some people had thought. Uh, with all the talk of recession earlier this year, which has kind of dissipated more recently. So yeah, I mean, I think the supply demand balance for oil, though, perhaps the narrative is not as bullish as for gas. I don't assume that the oil market's okay and that oil prices are going lower. I think there's a lot of value out there. And I think, we talked on your show maybe a couple of years ago, back in 2023, and, gas was the big value back then. If you remember, gas prices were, like $2,
They had crashed.
2.50.
Yeah, there was a
Yeah,
crash.
and there wasn't much hope for LNG exports in the near term because there weren't enough new plants coming on. Um, and these gas producers were all, terrible stocks to own, and nobody wanted gas. Gas was trash, and oil was all anybody wanted to talk about. And now we have like almost the opposite situation. So I do think that there's a lot of value in the oil side of the equation right now.
Yeah, no, artificial intelligence software. This if this was early 2023. I mean, that thing was all the software innovations from Chat GPT. People were just starting to play around with it. They didn't really understand all the gains that it could do. It was just starting to where okay, you could download the app on your phone and play around with the
Yeah,
stuff, and you could okay, it was going to be better than Google search. How much better? No one understood the energy usage picture for the data
yeah.
centers, the back end of the stuff that like, okay, yeah, you have this artificial intelligence learning language model software on your phone. The back end requires all these data centers and all this electricity usage. So I think that's a very good point you have that out of favor as a contrarian in the cycle there, people are looking at discounted assets. So BP still has some good assets. I think the main point though is over the last couple decades, they've just been absolutely terrible capital allocators, all the different management teams at BP. Remember, you weren't in college then. I was in college in the early 2000s. They rebranded to Beyond Petroleum. They didn't even want anything to do with oil. All their commercials, all their marketing material was all solar, wind, biofuels. And they were like, oh, we're going to be done producing oil in the next
Right,
something amount of years. It was
right.
absolutely ridiculous, which means that like their return on investment for a lot of these projects, Elliot, it was either zero or negative.
No, exactly. I mean, it's really stunning to think about it. I actually went to college, university in the mid '90s, and I went to college and lived in the United Kingdom at the time. And one of the first reasons I got interested in the energy business was because I had some friends and acquaintances who were at the University of London where I was, but they were studying, petroengineering and degrees like that. That was a really big thing back in the mid '90s. And BP was a big leader. They were producing oil and gas out of the North Sea. The United Kingdom as a country was exporting natural gas to other countries in Europe, right? Because of all the investments they'd made in growing the North Sea. They were energy independent overall, which was a huge advantage for the country and for the pound as well, the currency. And so, I remember that side of it. And I remember seeing this shift they did over the years where they moved from BP, which we all knew then, and I think most of us still now know stood for British Petroleum, right? To Beyond Petroleum. And then they took it a step further when they in 2019, 2020, when they announced this new strategic plan to slash their capital spending on oil and gas, allow production to decline, and increase their spending on renewable energy. So it's been, quite a transition, and it mirrors what's going on for the United Kingdom, unfortunately, as a whole. I mean, now United Kingdom imports natural gas, just like other European countries, because North Sea production has declined. I think that had they invested more, had the country been more receptive to investment in natural gas production in the North Sea for all those years, at least they could have stabilized gas production at a higher level. And they would be really enjoying that benefit right now with gas prices, electricity prices so high throughout Europe, oil prices generally very high in recent years. So, yeah, it definitely mirrors what's going on for the country as a whole and, BP as a company. Um, However, I would say that with all this sort of garbage, right, in BP, at this badly managed, botched transition investment, there are some good assets. In particular, BP, a lot of their best assets are right here in the United States. They have investments in the Gulf of America, right? So they've got oil and gas projects in the Gulf of America. One, which they've talked about potentially selling off a stake or taking on a partner because it's doing so well, and there are a lot of companies, big companies, who would be interested in. It's a deepwater Gulf of America play, and they also have onshore assets here in the United States, including in the Haynesville Shale, which is as we've talked about, is one of the foremost gas plays in the United States. In fact, they recently ended a joint venture they were doing so they could get more ownership over their assets onshore in the United States. So BP and they also have a lot of assets, by the way, in the Middle East, places like Iraq. So they do have a lot of great assets, and they've just been badly managed and underinvested in. They also have some people who are very good in terms of petro engineers and geologists and all that. They do have some know-how there. I really just wish they'd kind of stuck to their knitting all these years and just focused on what they're really good at, which is obviously not investing in alternative energy.
Well, now you have the strategic and you have the activist investors, excuse me, there, which are buying enough shares to get board of director seats, and they're either going to force asset sales or they're going to force the company up for sale because they recognize that the valuation is substantially lower. I remember looking a couple of years ago at the financials. I was looking at the income statement of BP versus some of the other oil companies, whether that was Exxon Mobil or Chevron or Royal Dutch Shell for comparison, and they just had way higher costs for producing oil and natural gas, and the profit margins were just substantially worse than all those other three super majors there. So I was like, well, they have good assets, but the financials and numbers are just way, way off. This company's not being run efficiently. If they could just cut the bad investments in green energy and focus on efficiency, this could be a good company. There could be a turnaround, but it seems there's like political issues with green energy, ESG, and DEI that BP basically stuck to these philosophies. So Royal Dutch Shell was in Europe too, Elliott, but they seem to at least they invested smartly in natural gas. Over the last 15 or 20 years, Royal Dutch Shell was doing investments in natural gas, liquefied natural gas. So they made a lot of profits on that part. So yeah, their green energy stuff lost a lot of money, but their natural gas and LNG stuff made a lot of money. BP didn't have that. And now here we are, BP's a mess. Definitely if Chevron or ExxonMobil, Royal Dutch Shell bought these assets, I think they could turn things around in a couple years.
No, I agree. And there is some precedent for it. You mentioned Shell. Shell actually did, as we talked about, like BP, go through this phase of investing in this energy transition. Their old CEO talked up electric cars, bought an electric car, made a big deal of it. They talked about lower forever oil and gas prices. This was in 2017 now. So literally right at the bottom of the cycle. Okay. They were talking about lower forever oil and gas prices. They talked about this on several conference calls. And their new CEO came in 2023 with this big strategic turnaround plan. And it basically is exactly what BP announced back in February. And it's a plan to increase their capital spending on traditional oil and gas projects, right? Cut some of their wasteful spending on, alternative energy, and basically go back to what they were always good at. And Shell has outperformed BP, Total Energies, even Eni, I believe, since 2023 because of this turnaround. So I do think it's possible. I think that BP is getting back on the right track. Back in a couple years ago in 2023, the CEO who was behind this transition plan was fired. And, they said it was due to an inappropriate and undisclosed personal relationship with somebody else at the company. But I got to tell you, the timing was awfully convenient, right? That may or may not be true, but the timing was awfully convenient. They got rid of him. The CEO CFO took over as CEO early last year and has gradually been shifting the company in this direction. And then in February of this year, he announced this, major shift in the plan. They were talking about uh, basically spending 14 to 18 billion dollars a year, US dollars a year, in the 2025 to 2030 era, overall capital spending. And now they've cut that to 13 to 15. But within that reduced CapEx, they've actually increased their spending on upstream oil and gas from 8.5 billion a year to 10 billion a year. So they're cutting overall capital spending to address their debt problem, but they're also increasing by a significant amount their oil and gas spending. And as a result, instead of 1.5 million barrels a day of oil production by 2030, they're now talking about 2.4 million with growth beyond that. So I do think they're on the right track. I think the activist investors are pushing for even deeper changes, including potentially spinning off the alternative energy business in its entirety, right? And using the proceeds to pay down debt. But BP is taking some other steps. I mean, they also own Castrol, the oil lubricant company.
The oil change. Yeah, they sell the oil for the oil changes. Yeah.
Yeah, and they own that. That had over $1 billion in EBITDA last year. And a few years ago, Valvoline sold off their lubricants business to Saudi Aramco. And I think the Saudis paid something like 8 or 9 times EBITDA for those assets. So, and that was a couple of years ago. So, I mean, I think Castrol could easily be worth, $9 billion or so. And they'll use that to pay down their excess debt. As I said, they're shifting their capital spending plans. But yeah, certainly, I don't think they're getting full credit for these changes yet because, investors are worried that, they may not be able to follow through on all this, right? That in the past, energy company turnarounds, they can kind of go either way.
Well, I mean, if they get bought, right, I would suspect if they do get bought by one of the 3 super majors, that the budgets would be slashed even faster. So the corporate overhead and the green energy stuff, you'd see it even faster. You'd see announcements in investments into oil, natural gas, liquefied natural gas, because it just seems like the hot thing right now. We've seen this with Chevron announcements recently. They want to go build pipelines or natural gas turbine power plants next to these data center projects that are under construction. The Stargate one in Abilene, Texas, is already under construction. I think Chevron has a partnership deal with General Electric. General Electric, one of their subsidiaries, is providing the natural gas turbines, and Chevron's providing the natural gas and the pipeline capacity, I think.
Yeah, no, it would definitely accelerate things. It would also improve their debt metrics, right? Because if you had a company with less debt like Shell combined with BP, they would assume BP's debt, but as a percentage of a larger company, it would be a more manageable debt load. So there are definitely a lot of advantages to going that way. I think another problem out there is that, as I said, the former CFO has become the new CEO of BP. And he's made a lot of what I think are positive changes. However, you got to remember he was CFO under the prior guy as well when this whole energy transition plan was announced. So I do think there's some, not suspicion, but there's at least people are keeping a close eye on this transition plan because a lot of the people at the top of BP, were also high up in the management team back in 2020. So,
well, you also have pressure too from political and bureaucracy and the pension funds in the United Kingdom. One of my friends bought a small cap company on the London Stock Exchange, and he called it a nightmare over a 2 or 3 year period with all the bureaucracy, all the legal requirements, millions of dollars in lawyers, all the extra time. He said he would never do it again. It was an acquisition of a really small company on the London Stock Exchange, and BP is one of the largest companies in their country. So I can imagine like for years, because I was covering BP as an energy analyst too. I mean, like there was so much pressure from the pension funds. The pension funds, they did not want their dividend cuts. So the pension funds that owned a lot of shares of BP in the United Kingdom, no one wanted a dividend cut ever. They own corporate debt for BP2 for extra like income, and then they also wanted all this green energy capital allocation. Well, you can't do all three if all your energy investments for wind, solar, biofuels are losing billions of dollars per year. You can't, run a business like that. You're going to
No, and in fact,
destroy the balance sheet.
that's exactly what they've been doing in recent years. It's they didn't want to cut their dividend. They've been growing their dividend at 8-10% annualized in recent years amid all this mess, right? And a lot of that's because they're getting, a lot of their traditional investors, including, UK pensions, are they want the share buybacks, they want the dividends, right? And
And they
they've
want
been
green energy
basically
too, but there you can't do all three. You can't do
so
all
they've
three.
been, they've sold off, they've done quite a lot of disposals in recent years, and a lot of that money has gone to basically paying these high dividends and capital returns. Under the new plan now, they finally have cut that, right? They're talking about around 4% annualized growth in the dividend over the long term as a target. But it can be less than that in years when commodity prices don't support that. That's already less than half of what they've been doing. So they are making changes, but yeah, I think some of these things could really accelerate it. You've got Elliott Management being the big one, I believe, activist investor that's involved in uh, that's really been pushing for change at BP. And of course, if they were acquired, um, that is one thing, though. You know, Chevron and Exxon would both be good acquirers. Exxon, particularly, I think would be a great acquirer for BP, and they certainly could handle that. An acquisition of that size, they've done plenty. They have low cost of capital. The debt burden would be no problem. They have good knowledge of all the assets, but there is some potential for the UK competition authorities to block a deal which involves selling out to a foreign buyer, especially an American buyer. Which is why Shell, I think, so much attention is being put on Shell, because Shell is, it's an Anglo-Dutch company, right? But their primary listing is now in London, and so basically you have a British company buying another British company. So yeah, that's one of the reasons why I think Shell has been the topic of so much discussion. Um, I remember a few years ago, both Total, which is the French giant, and Shell both talked on their conference calls about potentially changing their primary listing to New York. Okay. And so that caused a little bit of, chaos, if you will, because it made a lot of sense. U.S. energy companies have higher valuations, easier access to capital, and less pressure from their home governments to transition, do an energy transition type of project. So, by switching their primary listing to New York, they already have very limited assets in Europe. It made some sense, but BP is the only one who just totally ruled that out. And I think a major reason for that is because, whether they call themselves, Beyond Petroleum, or just BP, we all know it's British Petroleum. And so, at the end of the day, I think that the UK government would not really like it if BP had decided that they might want to switch their listing to New York, right? And so you could have some potential political issues there, as you mentioned, in terms of an American buyer buying BP, at least some complications. So, I think that's one of the reasons why you're seeing some talk swirling around Shell as a buyer.
I mean, any of the three, honestly, I think any of the big three super majors could run BP better. I think the
Yeah.
hurdles are not financial or balance sheet or anything like that. I think the hurdles are political. So with the UK government, the people running it, the bureaucracy with the regulators approving it, and then the pension funds. So the pension, all
Yeah.
three of those entities. So it's a political decision now whether or not BP is going to get bought. Because I honestly think any one of those three companies could easily run those assets far more efficiently than BP management has the last couple decades.
Yeah, and I think that's where you potentially do have an advantage. BP has underperformed so badly. The total returns from the stock, capital gains and dividends and all that have been so much less than the other US or European producers like Shell that at some point, a sale will actually significantly benefit, you know, an owner like the UK pension fund. So some of that, just the simple economics of a deal, may eventually outweigh, some of these sort of nationalistic or competition rooted concerns that, the political concerns out there, in the sense that, it doesn't benefit anyone, including the UK pension fund, to own a lot of a company that's not doing very well, which is a situation we're seeing right now with BP.
Oh yeah, I totally agree. And for the capital allocation, I mean, you can't run the business with all three of the capital allocation, growing the dividend, like you said, at that rate, with their balance sheet, with the amount of debt and the interest payments on the debt at higher interest rates, and allocating to all these green energy funds. You can't do that without, getting into the balance sheet mess and running the assets inefficiently or liquidating, selling the assets. So that's why BP it's just they're not getting the bottom line is they're not getting the return on investment for any of the green energy projects that they promised for decades now. That's the major issue for me, is that all these entities in Europe and the United Kingdom all wanted these green energy investments, and they never got the profits or return on investment that they were expecting. And here we are, many years of negative compounding that, and then they didn't want the dividend cut. So it's just not manageable anymore.
No, I agree. And, BP is a company that, I've recommended it as avoiding, or it's been my least favorite of the majors for many years now. My favorite has long been Exxon, because I just think they're the best operator, and they're the one that really did and continue invest, even though they caught a lot of flack for it. If you remember back in 2020, they're the one who really maintained their investment in the traditional oil and gas business, when everyone was trying to get them to do, pull a BP move. I remember there was an activist investor in Exxon back in 2020, 2021, who was using BP, okay, as a model for what Exxon should do. So imagine how that would have turned out. But yeah, I do think that for the first time in many years, I actually think that BP is interesting here because, again, they do have good assets. Their underlying assets are sound, but we just need to extricate them from, this disastrous strategy they've done since 2020, particularly, and even before that as well. But this energy transition plan is just, it's a proven failure now.
And if I could add one more thought here on BP, I mean, there is a ton of smoke here. So we're seeing reporters almost every day now from Reuters and Wall Street Journal and oilprice.com. These are people with good sources, and they're getting anonymous sources in the oil industry. And I'm speaking to people too, and they're like, yeah, BP, the assets are up for sale. BP may get bought in the next six to 12 months, maybe even sooner than that. So there's a lot of smoke here. I don't know how quickly, because BP's not a tiny company, and there's a lot of regulatory hurdles, because if you're ExxonMobil, you have to go to the UK pension funds. You have to do
Right.
all this due diligence. You have to get all the pension fund shareholders and the bondholders to sign off on this. You have to get all the politicians and bureaucrats. You have to get all these things signed off. So this may already be kind of going on behind the scenes before they come out with a formal proposal. But there is a lot of stuff. There's a ton of smoke that these about the buyout rumors. There's lots of people reporting from oil executives, they're anonymous and not going on the record because they're both publicly companies, but people are looking at buying them.
Yeah, and just the simple matter is that the stock it hasn't performed particularly well, but it's broadly outperformed the rest of for example, the S&P 500 Energy Index since last November or so. So that tells me that first of all, people have been anticipating this change in their strategic direction since late last year. And I also believe one reason that you're seeing BP hold up than a lot of other energy companies, even during the April mess, is just that people think it's likely to be acquired or have a even more dramatic strategic plan shift in the next 6 to 12 months. And something's kind of got to give there. But you've got a lot of people pulling for it now. Obviously, I'm sure the activist investors would love to see, Shell or Exxon or somebody step in and buy this thing. And so, yeah, I definitely think something's going on. It's a question of timing.
Yeah, I can't give you an exact time on how long it'll take. I mean, because like with the smaller company that got bought on the London Stock Exchange, I mean, from what I heard, it took like way over a year, year and a half longer than was anticipated, millions of dollars in legal fees. And
Yeah,
BP is like orders of magnitude larger than this tiny little small cap.
complicated, right? It's definitely a complicated thing, but in terms of a national pride thing too, right? Because it was their flagship energy company
Well,
well, it's been
their
it's the
capital
dawn of time.
allocation policies have made a mess of things.
Yeah, yeah, no, it's definitely true. I mean, but yeah, I do think it may very well take some time. But even if they don't get acquired or it takes a long time, I do think that in the next few quarters you're going to see some positive improvements in their financials, simply because they are finally taking the steps they need to take. As I said, Shell went through something similar, maybe not quite as bad, but something similar a few years ago. They did a similar about face on their strategy in 2023. The stock has subsequently rallied 30 some percent, which is well above the other energy companies in Europe and some of the US players as well. So yeah, I do think that even without an immediate acquisition, I still think there might be some value in BP, just simply based on the fact that they are making the right moves, and I do think that they'll see you could see some positive moves in the next few quarters. Maybe they announce the sale of Castrol, some other assets they want to dispose of. Maybe you start seeing that debt get paid down. Maybe you see some positive uh, production in terms of some of their assets in the Gulf of America, for example. So I, I don't think you need a deal for this to work out, because BP is just so cheap. But yeah, certainly I think it's very much on the table.
As we wrap up here, I have a question since we're an investing podcast here. Get your thoughts on ways that people can play the growth in liquefied natural gas exports, the data center build out that's occurring here in the United States, whether it's the Colossus one from XAI that's expanding to 200,000 NVIDIA Blackwell GPUs. There's plans to expand that even more over the next 5 to 7 years. And then the Abilene facility in Texas, the Stargate AI. Are there specific ways you think that people should look at? Is it the pipeline companies? Do you think Chevron has an advantage here building out the natural gas power turbines and the pipelines there to these facilities? Or do you think there's other better, smarter ways to play at better valuations?
I still think the best way to play the gas story overall is with the producers, and because I think they're the ones that have the most upside leverage to a higher gas price deck. And they're benefiting not only specifically from the build out of AI, although that's obviously a big part of it, but they're also benefiting from this rapid increase we're seeing in US LNG exports as these new terminals open up. Between the fourth quarter of last year, 2024, and the first quarter of next year, 2026, we're seeing 4 billion cubic feet of new LNG export facilities open up in the United States alone. And that's the fastest pace of growth in history of the industry coming out of the US. And in March of this year, we saw record US LNG exports, almost 14.8 billion cubic feet a day. So um, I think that the producers that are going to benefit from this are there are really two buckets I look at. And you have the very lowest cost players. And my favorite is EQT there. Symbol is EQT, not so creatively, but they're based in the Marcellus Shale region, which is in Appalachia. And they're one of the lowest cost producers in the United States. I would argue the lowest cost producer in the United States. And what's interesting as well about them is last year they actually acquired their midstream assets, the Equitrans, which was formerly part of EQT. They spun it out and then they ended up buying it all back. So that gives them control over the midstream assets as well, which is absolutely, absolutely crucial when you're an operator in Appalachia, because there's very little gas demand locally in Appalachia. You know, there are not that many people that live there, and there's certainly not any, AI assets or anything like that. So you need to be able to get, so even though the gas is extremely cheap to produce, you have to be able to get it somewhere where somebody actually needs gas. And so EQT now has a majority stake in the Mountain Valley Pipeline, okay, which allows them to move it um, out of Appalachia down into Virginia and North Carolina. They can move it north up into places like Northern Virginia, where you have a big AI build out. You can also bring it down to places like where I live in Florida, where demand for the gas is increasing because of growing electricity demand, and a lot of natural gas production.
It would be
So,
easier to build pipelines from the Haynesville Shale would in Louisiana to Florida, though, right? So that would be cheaper.
well, the Haynesville shale gas, I think what you're going to see, the main use of that gas is going to be directed at the LNG export market. And the reason is that, if you look at a map of U.S. LNG export facilities, right, they're basically all in Louisiana and Texas. Right? So, building a pipeline from the Haynesville Shale, which is in Louisiana, to the Gulf Coast is a simple matter, simpler matter than bringing that gas down from Appalachia. So, even though it's a little bit more expensive to produce, your average Haynesville producer needs sort of 325 to 350 or higher to make any free cash flow off production from the region, right? I think that most of that gas is going to end up destined for the LNG export market. And so I like some of the producers there as well. On the established names, I like Expand Energy. Company used to be called Chesapeake. They have operations in both the symbol is EXE there. They have operations in both the Appalachian region, Haynesville Shale, rather Marcellus Shale, as well as the Haynesville Shale. They really increased their acreage a lot when they purchased Southwestern Energy last year. And so they're the biggest producer really in the US now, and also in the Haynesville Shale area. And they already have a lot of contracts to supply LNG or natural gas to LNG liquefaction plants on the Gulf Coast at favorable prices. And the what you need for Haynesville gas in other words, with all this LNG export facilities opening up, the price of gas, I believe, is going to need to remain high enough to incent these Haynesville companies to produce more gas. Because what we saw is that, I mentioned a couple of years ago, we were talking on this show about the low price of natural gas. Well, you had all the Haynesville producers who were basically in survival mode. They were cutting capex. They were allowing their production to decline. They were just keeping a couple of rigs operating because they had long-term contracts on it, but they weren't really growing their production at all. But now with the natural gas strip prices for next year up $4.50, $5 a million BTUs, these companies can afford to allocate capital to Haynesville and actually grow their production. And so that's why I think one of the reasons you're going to have to see prices in the U.S. remain above $4.50 on average, because that's the price point that you need to incentive this production from the Haynesville Shale. So yeah, I like EQT on the Marcellus side, Expand in Marcellus and Haynesville. One more name that I would mention, and I must warn you, it's a little bit riskier name. It would be Comstock Resources. The symbol there is CRK. This is a name that is controlled. The company is actually controlled by Jerry Jones, the Dallas Cowboys guy. But he also had a long history in the energy business, so he definitely knows what he's doing. And I didn't like this company at all for a long time because they're a high cost producer in the Haynesville Shale, which means they really struggle to generate free cash flow when prices of gas are very low, as they were last year. And they were bleeding cash. They were taking on additional debt just to sort of cover their operations. They basically got bailed out by Jerry Jones, who took a larger stake in the company. However, the Haynesville Shale is centered in Louisiana, but there is a part of the Haynesville Shale that extends into East Texas. It's in eastern Texas. And the core of the play was always assumed to be the Louisiana portion because the wells there are a little shallower, a little cheaper to drill. But Comstock has really built up this huge position in the East Texas part of the Haynesville. And these wells are deeper. They're a little more expensive to drill, but their well results have been very impressive. And they recently announced back in, I think it was February, they have a huge contiguous acreage position in the Haynesville, in the East Texas Haynesville, the western. We call that the Western Haynesville because it's located to the west of the core. The well results have been really impressive. And I do think their costs are coming down because they're moving from kind of an exploratory type of drilling program to more of a production oriented drilling program, which means that, they've centered on an ideal well design for that acreage, ideal well spacing, all the things of that nature that you only learn by doing. They've gotten a lot of capital commitment to build out midstream infrastructure from a private equity fund to build out midstream infrastructure related to that Western Haynesville acreage. And I do think that ultimately the production cost there could be as low or close to, anyway, what we're seeing in the core of the Haynesville. And they could very well be one of the larger producers in the play in a few years' time if it continues to pan out. And it's not just, some sort of fly-by-night thing. You have a couple of companies already producing in the Western Haynesville, including some Japanese producers, some Japanese companies that own Mitsui, I believe, is one of them, that own significant acreage in this Western Haynesville play, and at least see enough of an opportunity there to maintain or grow their acreage in that area.
Do those producers
so
contract? Sorry to interrupt you. Do those producers contract with like a LNG export facility that's right around there? Say the one that Woodside took over from Tellurian, that's the larger one that the Saudi Aramco may buy into. There's substantial rumors that Saudi Aramco may buy a 30 or 40% stake in the Woodside facility in the Haynesville area. So do the producers in that area, do they negotiate with the liquefied natural gas exporter and say, this is the we're going to get like a certain amount above the spot price to lock in, so you get your supply, we get a profit? Are those the types of deals that are normally negotiated?
You do see those deals, because the producer has to uh, justify and support the level of capital spending they're putting into this play. So they need to have some sort of a guarantee that prices that they could sell it for are going to be high enough to support their business. And you got to remember that the international price of gas is much, much higher than the U.S. price. So if you go to Europe, sometimes the price of gas in Europe can be 5 or 10 times higher than in the U.S. So they definitely do work out deals with the LNG liquefaction companies, not always on fully disclosed terms, but they do work out deals to supply a certain amount of gas to these plants, at a certain spread over the benchmarks, so that they can kind of lock in some sort of guarantee of profitability from all the investments they make to produce and transport this gas to those facilities.
Okay, so Jerry Jones Comstock, they're not just building out all these wells on spec, then he would be negotiating then with whatever liquefied natural gas export facilities are around the Haynesville area.
Yeah, they would be doing that. And the other thing is, one thing that really not kind of started to evolve my mindset around that Western Haynesville acreage is they managed to go to a private equity firm, obviously showed them a little bit of the books of what's going on there and got them to agree to fund 100% of their midstream infrastructure build out in that region, which is expensive, up to a certain amount. So obviously there's more than just Jerry Jones that and some Comstock investors, right, who think that there's something to the Western Haynesville. So I do think, again, it's a riskier play, but I do think it's a play that has significant upside if this Western Haynesville acreage continues to pan out. So we actually have that as more of a trade type of play than, I think, a name like, if you're looking for slow and steady with some leverage to the story I'm talking about, I mean, I think a name like EQT or Expand. But if you're looking for a little more juice, potentially something that could get bought out as well, I think Comstock is an interesting name to consider. Also, of course, you mentioned, I definitely think the midstream is an often overlooked way of playing this story. So you have names like Energy Transfer, symbol ET. You have names like Enterprise Products Partners, right? You have names like Kinder Morgan. They all have access to, they're all involved in building out natural gas related infrastructure. In Enterprise's case, there's a lot of natural gas liquids related infrastructure, and that's crucial because a lot of the of gas producing fields with the natural gas, you're going to find natural gas liquids like ethane, propane, butane that can be sold off separately and must be removed from the natural gas, the raw natural gas stream. So, these companies are perhaps a lower risk way of playing the same story. Most of them have little or no exposure whatsoever to the actual price of natural gas or any other commodity. They're more of a volumetric play, right? So if the production goes up and the cubic feet of gas moving through their pipelines rises, they have exposure to that. And they're very free cash flow positive. And therefore you tend to see these midstream names, even if whether they're organized as master limited partnerships, right? Like Energy Transfer or just regular corporations, right? Like Kinder, they tend to offer a very attractive dividends. So if you're more of an income oriented investor looking to play some of these same trends, I think that's a great way to go. And to me, EQT's decision to buy Equitrans last year should just underline the fact that midstream assets are absolutely crucial to the industry as a whole. So they're not just some sort of ancillary play or something that's just a high income vehicle, right? They actually are critical to the whole business mix, and that's why EQT bought Equitrans, because you need that transportation infrastructure. So I think that's definitely another way to look at playing the same basic growth.
I think there's a lot of potential free cash flow growth and growth of other pipeline capacity, at least cash flow tolling there with the infrastructure, because what the Matterhorn pipeline came on from the Permian Basin, and from interviewing other experts, Elliott, it sounds like there still is more pipeline capacity needed to take all that natural gas byproduct from the oil production in the Permian Basin to move that either to LNG export facilities, and then whoever gets these pipeline contracts or a natural gas power plant next to one of these massive data centers, I mean, they're going to mint money. That's like a steady stream of business there, building out the pipeline. There's a massive amount of potential profits there too, because these data centers, once they're invested in, I mean, they're going to have to upgrade these things. They're going to be expanded. We're already seeing talks of expansion plans for the data centers that are under construction now, or that came online, like the Colossus one from XAI that Elon Musk built. There's plans to expand that from 200,000 NVIDIA Blackwell GPU chips up to 1 million in the next 5 to 7 years. I mean, that's a lot of potential energy and electricity usage demand growth from natural gas. And those areas don't have nuclear power yet. So natural gas looks like that could take all the market share for that.
Yeah, I mean, I think that the Permian is kind of another whole issue. You've got the Matterhorn pipeline you mentioned, which basically takes natural gas out of West Texas and moves it towards closer to the Texas Gulf Coast. And that was a project that Devon was a leader on. Devon Energy is a major producer. And if you look at Devon, natural gas is about a quarter of their production mix, right? So their production mix is basically a little less than half of it is oil, and then the other little more than half is a mixture of gas and natural gas liquids. Okay, natural gas is a headache for them because the West Texas area has way too much gas, because everybody out there has been drilling all these wells targeting oil, and this gas is just naturally occurring with the oil. So it's kind of a waste byproduct of their oil production. But because they've been growing their oil production, or trying to grow their oil production at some level in recent years, or producing at a relatively high plateau level the last couple, the ratio of gas being produced from their wells to oil is rising. There's been this kind of explosion of excess gas in the region. Now, there's very little in West Texas to do with it. There's not enough people, not enough local demand. So you have to move it out of that area. Last year there were quarters where Devon was making, even after hedges, like 50 cents a million BTUs for their gas production from there. And so everybody was excited about Matterhorn, which I think started up in October, November of last year, right? And we saw in Q4 and Q1 the price of gas for Devon was getting for their production, it closed the gap to Henry Hub. So the prices in West Texas are way lower than Henry Hub, which is the NYMEX benchmark, right? And that gap closed a little bit. But now it's started to open up again. So you're seeing, we call that WAHA, the WAHA hub, WAHA hub. Gas prices are very, very low again relative to Henry Hub. And as Henry Hub prices have been going up, Waha gas has been really weak. And the reason is that Matterhorn is already full and they need more gas pipelines to open up just to handle the amount of excess production in West Texas. So, you're going to see it's a major problem for producers there, and they're going to continually want to try to get more of their production out of West Texas because, it's completely useless and has very little value there. That's another example of why energy infrastructure is so absolutely crucial. We saw it not that many years ago, 2017, 2018. We saw it in oil, right? You had oil in Midland, Texas, which is in the Permian, was trading at a huge discount to the same oil in Cushing, Oklahoma, or Houston, right? Or Louisiana, places like that, where it could be loaded on ships for export. And again, it was because of lack of infrastructure. And you're seeing bottlenecks like that all over the place. That is definitely that's definitely should underline to everyone the importance of midstream. And I think there's a perception that these are kind of like lazy
No growth,
ways to
boring.
play.
Yeah, no growth,
Yeah.
boring. But whenever I hear an announcement, and I'll just give a current event one, the new one in the last like 2 weeks is Venture Global, which is the hot IPO, the
Mm-hmm.
liquefied natural gas export company that just went publicly traded. They just got permits, Elliott, to expand their liquefied natural gas export facility again over the next 35 years. They're going to actually be larger, I think, than Cheniere Energy. I can't even imagine all the pipelines and the other infrastructure needed to massively increase liquefied natural gas export capacity. So the average investor doesn't think of the knock-on effects that are required for all the pipeline capacity and all the other stuff. So Venture Global can massively increase the LNG exports to a larger amount than Cheniere.
Yeah, and I think those are also Cheniere, and they're also ways of playing the same trends. I just think the pipeline side of it kind of gets overlooked because everybody talks about, well, there's talk about producers, there's talk about companies like Cheniere that export the gas, but that middle part is very important too, right? The actual pipelines to
Well,
move.
the gas is trapped then. It's stuck in the Permian. You have to
Yeah,
get it to the facility.
it's stuck to Permian, it's stuck in Appalachia, it's stuck someplace you don't want it. And I think that's got to change. There's even been some talk. There was a pipeline that was originally planned to move natural gas from Appalachia to New York State, because the idea being that the Marcellus Shale is right there next to New York. New York has extraordinarily high electricity prices and gas prices because they don't have any pipelines connecting New York to Appalachia. So that makes a ton of sense, right? You have a problem of very high electricity prices, very high natural gas prices. New York State, I think you'll find, can be pretty cold in winter, right? So you need the natural gas heat. And you have this prolific, massive natural gas shale play with very low production costs, just a couple 100 miles away, right? You see where I'm going with this, right?
Yep.
So building a pipeline.
Massachusetts had the same problem, and I think what they were importing very, very expensive
They,
liquefied natural gas
yeah,
imports too during the winter.
they have liquefied natural gas imports going into New York and New England, right? To make up for the fact they don't have enough domestic gas there. And sometimes it's cheaper it's not US LNG, it's LNG from other countries because of regulations concerning, the crewing of ships. Right? It can be actually more
There's
profitable for them.
it's old laws, right? It's the Jones Act or something.
Jones
I
Act,
remember
right? Which
Doomberg talking about this years ago. It makes no sense, but like the Democrats and the environmentalist lawyers and the NGOs that have been blocking the pipelines and suing it, like it's one state over.
yeah,
You
no,
don't have to.
it's crazy, and it would make so much. I mean, it's just a no-brainer. I mean, it's the stupidest thing you can imagine. Not taking that gas that's right there that you desperately need and bring it into New York. And there's been some talk of potentially reviving that plan now. Obviously, the president's pushing for it. Donald Trump's pushing for it. But you even have some New York politicians talking about it for the first time. So
Well, I'll
you
tell you,
could
if they
see some
can't
of that
build
stuff coming.
Well, if they can't build a pipeline one state over to New York or two states over or three states over to Massachusetts, only a couple hundred miles, I'll tell you that the Northern Virginia area, the DC metro area, all the big tech companies are spending over hundreds of millions of dollars buying up the land to build data centers. They will
Yeah.
take all the natural gas and the pipelines that they can get. The pipelines will be built then down here to Northern Virginia and other parts of Virginia for the data centers because we already have a lot of data centers, and the stuff being planned is even larger on another scale.
Yeah, no, there's definitely, there's just, my point is just that there's a lot of different midstream infrastructure that, we should build as a country, in my opinion. And there's a lot of potential there if we could kind of block some of these things. The Mountain Valley Pipeline, which is going to be, and it already is, a major way of getting gas out of Appalachia to interconnections where it can go up or down the East Coast, right? And including a lot of it's going to end up in Northern Virginia, a lot of it's going to end up down here, right? Fast growing states. But yeah, that was the only reason that pipeline actually was approved and built. If you remember, there was a ton of environmental opposition to it. The part was going through Virginia, through Southern Virginia. And the only reason it got built is because Senator Manchin of West Virginia cut a deal with the Biden administration to get his vote on the IRA, Inflation Reduction Act. And part of it was they had to basically approve this pipeline. That's the only reason it got built. So the most logical projects on Earth, right, are being blocked by this environmental opposition or this political maneuvering. But if there are a lot of potential highly profitable midstream projects in the United States that could get built in future if there is eventually political will to do so. In the meantime, the existing assets obviously are even more valuable. And so that's why, I think that, EQT's decision to buy Equitrans was probably like a very savvy move because they realized that there's probably not going to be another pipeline like MVP for years, if ever, right? But, so these big midstream companies in the US that already have these pipelines in place, permitted and built and running, they benefit because, their assets are sort of irreplaceable, I guess you could say.
And as difficult as the story that Elliot just explained sounds, the U.S. still has the best pipeline infrastructure, arguably, in the entire world. We have the most
Yeah.
amount of pipelines, the most mileage. So, in specific states, so it's probably easier to get pipelines built in Texas and Oklahoma. But like in the Northeast area, it is very, very difficult because there's just so many people that are anti-fossil fuels. It just makes people's lives worse, though, because of all the rules, regulations, red tape, the lawsuits. The fossil fuels end up coming in anyway, right? From the LNG exports, and people are paying their average regular person, small business owner, paying through the roof on electricity costs that they shouldn't have to.
Right. Yeah. There's a huge loss in terms of the economy in a place like New York, which should enjoy. I mean, the frustrating thing is a state like New York should probably have lower electricity prices and lower gas prices than a state like Florida. Probably should. But the exact opposite is true, right? Because they don't have the pipeline from this very nearby, right, asset into New York State. And so it's definitely a huge loss economically. But there could come a time with the right political maneuvering where people start to get fed up with paying out the nose for energy costs, electricity costs, and some of these things get approved and done. Because it's really not benefiting anyone. The current situation, really, right? Um,
I
Yeah,
think you're
but
starting
it's
to
a
see a lot
very,
of you're starting to see a revolt, whether that's Germany or the
you
United
are
States in recent elections, where like
absolutely.
a huge spike in electricity bills and it directly affects the voters, small business owners, that they're like, enough. We're tired of this stuff. The policies that these politicians try to, environmentalist lawyers, bureaucrats, politicians try to put in place, you hurt people economically. I mean, like I think in England during the pandemic, there was $1,000 a month increase in electricity bills for small
Hmm.
business. The average small business owner can't afford that. They're barely getting by. I mean, like an extra $1,000 a month in your costs is really, really high.
No, yeah, I mean you're definitely you're already seeing some shifts underway in places like Europe, where countries are making some moves to sort of reverse some of their environmental policies of recent years, or at least soften the blow, because electricity costs are out of control. And one of the things we learned over the years, I think you noticed that big power outage in Spain. When you start incorporating a lot more renewable energy in your grid, it becomes a lot more complicated to manage. It also becomes a lot more expensive, right? So
You don't have good, reliable backup battery
you
backup
don't
because
have a lot of
the solar and wind should be peak load, and you need reliability for base load. And they've done the opposite with the ESG and the green energy policies, and that's how you get the blackouts and the brownouts so quickly. Is they're doing the exact opposite of what they should be doing.
exactly. So yeah, I mean, I think there's definitely going to be some movement in some of these countries in favor of this. The midstream is, I think, an often overlooked step in the whole process, because if you actually look at these companies, read their calls, they spend a ton of time talking about midstream. Um, in some cases, more talking about midstream than upstream. And I mean, just to give you a sort of an idea of what's at stake here, EQT, when they purchased Equitrans, their break-even cost for natural gas has always been among the lowest in the country, sort of that $2.25 range for NYMEX, right? But they're getting it down to more like 175, simply because they're able to um, reduce their midstream costs, their transport costs. So there's a lot of real financial benefit to all this. That again, I think it gets overlooked because it's kind of boring. But pipelines are, definitely uh, an unloved and overlooked and very crucial link in the whole supply chain. And we're seeing it in Canada too. I mean, another company that we like is Ovinativ, symbol there OVV, and they actually have. There used to be in Canada is what that used to be called, but they redomained here in the U.S. and but they have significant acreage in Western Canadian play, the Duvernay Shale. And there's actually LNG Canada is opening up this year, which is exporting gas out of Western Canada. And they're right there. And again, it's a situation where Canada had all this gas that was basically stranded in Western Canada in this massive shale field, very cheap to produce, but it was basically worthless because they couldn't get price for it. And now they're seeking ways of exporting it to basically Asia, right?
So you
And
get a higher price. Yeah, you have to have the infrastructure of pipeline because, like, I remember years ago when the shale fields didn't have pipelines. So the Bakken field in North Dakota didn't have pipelines there. They were putting the oil, the shale oil, and some of the natural gas went on a train, and these train cars were not very safe. Warren Buffett was investing in this, but there was tons of like crashes and explosions and stuff. So the infrastructure was required. I think Elliot, for the first time over the last couple of years, this is something I'm really noticing. All the tech companies, whether it's Microsoft, Amazon, Google, Meta, and then all the tech investors, all they talk about now is besides the artificial intelligence software and the data centers, they're saying that they need to negotiate with the nuclear power companies and natural gas companies. They're talking about that they have to work with all these manufacturing companies and all the energy companies. They have to be a coordinated effort here because the stuff they have planned is such a massive scale, and we're talking about potentially an order of magnitude increase in energy and electricity that they realize they can't cut corners, they can't skip it, and that's why you're seeing like all these tech companies now, they're talking about nonstop nuclear power, small modular reactors, and securing natural gas supply.
no, yeah, I mean, I got to admit that 3 or 4 years ago, I never would have suspected that the companies I cover in like natural gas and nuclear power would become an artificial intelligence play. But I mean, it's totally legitimate, and it's definitely happened. And we're seeing power demand here in the U.S. growing at the fastest pace since the 1950s, which is back when the country was growing. Americans were migrating out of cities and into suburban areas, and so power demand was just growing by leaps and bounds. And now we're seeing it grow at the same pace as back then, mainly because of data centers and AI. And it's just I think there was a lot of complacency in the United States about the need for power to manage all this and to actually meet this growing demand. And that you're starting to see the effects of that today, in the sense that these natural gas is in the news, nuclear power is in the news. Certainly wasn't the case 5 years ago, right?
I'm seeing commercials every day.
Yeah,
So
and I mean,
when they mention artificial intelligence, software data centers, is always we have to get the infrastructure and the power. People are finally realizing all this, that you have to have all these things together. You can't just skip to the artificial intelligence software on your phone.
right.
There's a ton of stuff on the back end, the new data centers, all the natural gas pipelines, the nuclear power plant around it. There's so much more complexity on the back end of the stuff, so people can use the software on their phones or their desktops or laptops.
Right. Right. It's definitely quite a shift in mentality. And yeah, you're seeing it on the nuclear side as well. Also you're seeing some countries like Japan that were totally wanting to phase out nuclear. They're now moving in the opposite direction, right? Because they realize how critical it is to meeting their needs.
Well, I would
And
say I think we've realized, Elliot, that we're so underinvested in cheap, stable baseload electricity, whether it's nuclear power, next generation nuclear power, that we have to do a full 180. I think that's like the main theme over the last couple of years, is that there has to be a new type of energy policy here, that we can't block all this stuff, because otherwise the technology is just going to be totally blocked and handcuffed.
yeah, and and frankly, it's a major advantage that the U.S. has over most other countries around the world, which is that we do actually have abundant domestic energy supply, and
Especially,
really
yeah,
it's
natural gas. Yeah, for sure. We have like
natural gas, and we have a lot of oil production relative to what we need. We do actually have a lot of advantages there, and know-how and everything else. So, but if you look at it from a 30,000 foot view, the S&P 500 energy index, right, is less than 5% of the S&P 500, right? What's tech? 25, 30%, something up there. Um, the idea that one of the smallest sectors in the entire stock market is so crucial to the biggest sectors in the stock market, I think is something that's going to have to change over time. I think energy is going to have to become much bigger, because the demands on American energy production, transport, everything are going to be growing so rapidly and so high. So if you think about it, at the top of the last peak, let's call it 2014, late 2014, uh, energy was 15% of the S&P. Maybe it doesn't get back there, but maybe it goes to 10. I'm just saying that um, it's hard to separate energy from the rest of the economy. And I think for too many years now, energy's been kind of an afterthought. Nobody cared because it's so small. Oil and gas prices have been depressed, really were depressed from 2014 up until 2020. It's a long bear market, and now it's definitely front and center once again. And I think it has to become a lot bigger, because this industry, capital spending, has to support um, a crucial commodity for all these other industries, including tech, you know?
Well, I have capital expenditure for big tech, and this is just the five or six largest ones in the US. This is not counting Stargate, not counting European Union, what they're going to be spending on data centers, or the Chinese with Alibaba and some of the other large Chinese tech companies that are also investing in artificial intelligence software and data centers. I mean, we're looking at potentially $300 billion in capital expenditure for 2025. At least that's the public guidance for the five or six largest tech companies just in the United States, not counting the other stuff. And if our listeners want to see the scale that things are, there's mini documentaries of a reporter and Sam Altman for OpenAI going around the construction now at the Stargate AI data center facility, like what they're doing. I don't think they have accurate estimates on natural gas usage yet, but basically the first two data center buildings are going to be coming online, like I think in the next 12 to 18 months. And they have plans to scale it up for another six data center buildings over the next 4 or 5 years after that. And we're talking like 1.2 gigawatts of electricity usage. And that's absolutely an insane amount.
Yeah. Yeah. And you contrast that with the entire global energy industry on upstream spends somewhere around 250, maybe $300 billion a year on exploration development. So, and you've got all that, you've got all of what you're talking about being supported by, what the energy industry is producing. And in my mind, over time, you know, uh, energy capital spending globally is going to have to go up to supply enough energy to meet, this rapid growth in demand. I mean, it
Yeah, or
really
we're
is
gonna
that
we're gonna
simple.
have to have a breakthrough in the nuclear power side with the small modular reactors or crack. I mean, they're talking about building a nuclear fusion power plant here in the Northern Virginia in the next like 7 years. I don't know, like the people, it's mixed when I hear people bring this up because like I know they announced plans for it, but the people I've spoken to are like it's 50-50 on whether or not they're actually going to get anything close to the timeline.
Right.
So
Yeah. And we've heard about some of the. I mean, I think that reality is that for the foreseeable future, it's going to have to be kind of all of the above. You're going to need to have nuclear. You're going to need to have natural gas. You're going to need to have some of these countries. You're going to need to have more coal. I mean, that's the truth of the matter. A lot of countries cannot run without coal, and you're going to see that. I mean, even Germany is using more coal. Um,
until the LNG facilities are online. So like because they were
yeah, but
taking liquefied natural gas, they were getting it from Antwerp, right in the Netherlands, and then it was going a truck or pipeline because they didn't have the LNG facilities over the last like 5 to 7 years, and they were shutting down nuclear power plants too.
yeah, they've now shut all their nuclear capacity, and if they have a cold winter like they did last year, they run low on gas supply, and prices go up. So I think that one of the biggest mistakes the countries like Germany have made you know, is just from a strategic point of view, it's not a good idea to become too dependent on any one source of power, right? You don't want to be all in on natural gas. You don't want to be all in on nuclear. You want to have like some mix, right? So that uh, it's better, easier to manage your prices, supply, et cetera, if you have some mix of energy production technologies. And a lot of countries in Europe made the mistake of going sort of all in on gas, just assuming they would have access to cheap supply from Russia forever, right? And they went all in on renewables, which are very intermittent, and they don't really help when you need them most. So yeah, I mean, I think you're going to have to see there will be technological developments in things like nuclear, but for the foreseeable future, I think you're going to need all of it, literally all of it, all those technologies, gas. You're going to need oil, not for electricity production, but for transportation use. Uh, you're going to need nuclear.
And
Just
when the
everything.
tech companies are spending the money for these data centers, like one of the most important things, and you hear the tech people talk about this, is that they have to negotiate ahead of time. They want a secure nuclear power supply, so they're building the data center around a nuclear power plant, or they want to make sure that they have the natural gas pipeline capacity and they have a price locked in. So the energy is probably the most important part of the equation there. They do not want price fluctuations, or they don't want to risk like of Europe, where they just don't have any power coming in, any power supply.
Right. Yeah, you don't want to be in a situation where you need access to always on power. So you have to have something that is super reliable and guaranteed access, etc.
And so that's these data centers are actually all the above. So like Trump's policies for energy, they're marketing what, and his energy secretary are all the above. These data centers are all the above. So yeah, you can put some solar panels or some wind turbines around the data center, but that's not going to be supplying the main power, Elliot. You have to have reliable power with nuclear energy or natural gas pipelines.
Exactly. I mean, you've seen, it's interesting to contrast the experience of a state like Florida with a state like California. Both states have expanded renewable energy capacity a lot in recent years. Florida is one of the fastest growing renewable power states in the United States. And, both California and Florida have advantage with solar because we have sunny weather, right? But the difference is that, you know, Florida has kept natural gas capacity. We've kept nuclear capacity. California has shut down a lot of that, right? So, our power prices here in Florida are basically in line with the national average, and California is one of the highest, most expensive in the country. And so, that again, if you go all in on one power source like solar, you're going to have problems. But if it can certainly be part. I'm not saying it can't be part of the mix. It just the idea that you can replace gas, nuclear with solar and wind is ridiculous. It doesn't mean it can't be part of the mix, but that's all it's going to be is part of the mix. It's not going to take over, which I think is something that a lot of people believed or were complacent about for many years, including whole countries like Germany, right? But
And
we're seeing
California,
it.
yeah, I mean, look at the bad policies from Gavin Newsom that he was shutting down
Yeah,
all those oil refineries and driving up the cost of gasoline and diesel for people in California too.
yeah. I mean, you're seeing it now. Writ large. Another one of their big refineries is closing next year, I believe they announced. So there's a shortage of refining capacity in California, and nobody else wants to make gasoline to the California standard because it's too expensive, and they don't have any pipelines to get it there, so it has to be moved in by tanker. So, from Texas, right? So, I mean, these things do come home. These bad policies do come home to roost eventually. And when people realize what's happening, then that's when people get angry and you start to see some movement, right? But the real solution is going to have to be that we're going to have all of these things.
Oh yeah, I totally agree. Potentially, we're looking if this data center build out continues at anywhere near the pace that's being projected over the next 5 to 10 years. I mean, we're looking at potentially an order of magnitude global electricity usage demand increase because some of these other countries they're just announcing plans now to start catching up to the U.S. with data center construction, like European Union, United Kingdom, some of these other countries. So there's just no, we're drastically underinvested for natural gas and nuclear power, in my opinion, and I think there's good value for oil. I want to thank you so much for your time today, Elliot. I've kept you for almost 2 hours. I don't have the exact time on me right now, but I'm surprised that you could be coherent for almost 2 full hours. You're a true expert in your field for oil and natural gas, and I'm sure some of my listeners will like this long discussion.
Well, thank you very much for having me on. It's always a pleasure to discuss energy with you. So,
Yeah, it's a great time I think because like whenever I hear the tech companies, they always bring this up now. So they're all like, "Oh, they're actually doing heavy manufacturing, construction. They're locking up their energy contracts." So it's a really exciting time for an energy investor because the tech companies are pushing all of this stuff forward.
yeah, absolutely. I mean, it's something that, again, you might not have thought of a few years ago, but now it's definitely front and center. As you do, I'm sure I listen to a lot of these conference calls, and you're seeing a big spike in mention of the energy issue because it's such a potential issue or competitive advantage for companies in all sorts of industries.
Well, imagine the embarrassment if you spend like many billions of dollars building out one of these massive data centers like the Colossus AI one in Tennessee or the Stargate one in Texas, and you don't have your cheap electricity and your power situation handled. Imagine how embarrassing that would be.
Yeah, I mean, it could be it could threaten your survival for some for some companies, right? So
Well, I mean, there's going to
it's
be
mission
people.
critical.
Well, there's going to be people fired if the power isn't locked up like that, and then the share price will crash because it just makes the management teams all look bad. So, I mean, like that's one of the most important priorities now is making sure you get you're close to a nuclear power facility or you have the pipelines and the energy situation with the natural gas locked up. So, like you have like all these large companies like Oracle and Chevron and General Electric. They're all involved in the Stargate AI facility, along with NVIDIA, of course, and Microsoft and OpenAI.
Yeah, absolutely.
Yeah, it's just all these companies are working together. It's kind of what America was founded on, right? All these companies in different industries cooperating with each other to provide value added and innovate.
Yeah, no, exactly. And it's energy is just one of those industries where it never gets boring, partly because it's so important. It's the lifeblood for the economy. So it connects with pretty much every industry in the United States in one way or another.
Yeah, I totally agree, and especially now for the computing power increases at the data centers, because like basically the computing power for the GPUs at the data centers, I've seen estimates that basically like it's increasing enormously every 6 months. I mean, you cannot do that without having stable energy and having the power supplied.
Yeah, no doubt.
Well, thank you very much. If my listeners want to follow, take a look at your newsletter or your paid newsletters or your free newsletters, how do they do so?
Okay, well, my main newsletter covering energy is called Energy and Income Advisor, which is energyandincomeadvisor.com. We put out a full issue every month. We also have model portfolios tracking all the energy sectors. A lot of the stocks that we talked about today or sectors we talked about today. I also have on Substack, substack.com, I also have a free newsletter called Free Market Speculator. I write a lot about energy there, addressing some of the topics we talked about today: natural gas, oil, as well as the general commentary about the economy and markets. But also, I love to hear from readers on Free Market Speculator. You can leave a comment, and I do try to get back to all the comments. So that's a great place if you want to get an idea of the type of research I do.